Did you know that understanding cash flow is like having a secret key to unlock the hidden treasures of business success? Welcome to the world of business finance, where the term cash flow often sends shivers down the spine. But why is this so? And should it be? Let's start with the basics. Cash flow, simply put, is the movement of money in and out of your business. Think of it as the blood circulating in your business's veins, vital for survival and growth. It's the lifeblood that keeps the heart of your business beating, determining its health and vitality. A positive cash flow can be the difference between a thriving business and one that's gasping for air. It's the reason some businesses soar to great heights, while others plummet into the abyss of failure. So what's the secret to mastering this elusive concept? How can you harness its power to fuel your business success? So buckle up as we embark on this fascinating journey to unravel the enigma of cash flow. What is this enigmatic thing called cash flow? Let's break it down. Picture a river. Cash flow is much like that river, a stream of money flowing in and out of your business. It's the lifeblood that keeps your business alive and thriving. When we talk about positive cash flow, we're referring to situations where more money is flowing into your business than out, leaving you with a surplus. This is the ideal situation for any business, as it allows for growth and expansion. On the other hand, negative cash flow is when more money is flowing out of your business than in. This could be due to high expenses, low sales, or a combination of both. If left unchecked, negative cash flow can lead to financial troubles and potentially the end of your business journey. There you have it, the cash flow decoded, but how do we measure it? Enter the cash flow statement, the magical map that shows you where your money is going. Like a compass pointing north, the cash flow statement directs you to the three critical sections you need to explore: operating activities, investing activities, and financing activities. Operating activities, as the name suggests, revolve around your business operations. They're the day-to-day transactions that keep your business running. Think of them as your business's heartbeat. This includes the cash inflows from selling your products or services and the cash outflows for paying expenses like salaries, rent, and utilities. Next up is investing activities. This section is like the growth hormone of your business. It comprises the cash that goes in and out from the purchase or sale of long-term assets like property, plant, equipment, and even investments in other businesses. Lastly, we have financing activities. This part is like the business's oxygen supply. It's all about how your business raises capital and pays it back. It includes cash inflows from borrowing money or issuing stock, and cash outflows for paying dividends, buying back stock, or repaying debt. Now, creating a DIY cash flow statement might sound intimidating, but it's simpler than you think. Begin with the net income from your income statement. Then adjust that number based on changes in your balance sheet accounts like accounts receivable, inventory, and accounts payable. This will give you the cash from operating activities. Next, look at the changes in your long-term assets to calculate the cash from investing activities. Lastly, examine the changes in your long-term liabilities and equity to get the cash from financing activities. Add these three figures together and voila, you have the net change in cash. Now that we have our map, it's time to learn how to navigate it. The cash flow statement may seem daunting, but fear not, for it holds the key to your business's financial health. Think of it as a map guiding you through the terrain of your financial landscape. To navigate this map effectively, we'll need to understand its key features: operating activities, investing activities, and financing activities. Operating activities are the heartbeat of your business, the day-to-day operations. Here you'll find cash inflows and outflows from sales, cost of goods sold, and operating expenses. It's important to keep your pulse on this area, as it shows how much cash your business is generating from its core operations. Investing activities, on the other hand, are more long-term. These could be purchases of equipment, acquisitions of other businesses, or investments in marketable securities. By scrutinizing this section, you can gauge how your business is investing its cash to grow and expand. Financing activities show how your business funds itself. This includes cash from loans, issuing shares, or paying dividends. This section gives a glimpse into how your business is balancing debt and equity to fund its operations and growth. Now let's talk about efficient invoicing and receivables. The quicker you collect payment, the healthier your cash flow. This involves timely and accurate invoicing and diligent follow-ups. Cost-cutting strategies are also crucial. Every penny saved is a penny earned. Look for opportunities to streamline operations, negotiate discounts, or reduce overhead costs. With these tools, you can navigate your cash flow statement like a pro. But what happens when unexpected storms hit? In the unpredictable seas of business, an emergency fund is your lifeboat. It's not just a safety net. It's a strategic tool that can contribute to the overall health of your cash flow. Let's take a moment to appreciate its importance. An emergency fund is a stash of money set aside to cover the financial surprises life throws your way. These unexpected events can be stressful and costly. In the world of business, the stakes are even higher. A sudden equipment breakdown, a market downturn, or a global pandemic can have a significant impact on your revenue. Having an emergency fund can mean the difference between staying afloat and sinking. But how do you build one? Start by determining how much you'd need to cover 3 to 6 months of operating expenses. Then make a plan to set aside a portion of your profits each month. It might take a while, but remember, Rome wasn't built in a day. Here's the exciting part. An emergency fund isn't just about survival. It's also about maintaining positive cash flow. When a crisis hits, you won't need to scramble for funds or take on high-interest debt. You can pay for unexpected expenses from your emergency fund, keeping your cash flow steady. With an emergency fund, you're ready to weather any financial storm. But how does this theory apply in the real world? Theory is great, but let's dive into the real world with some cash flow case studies. First, let's explore the tale of a small family-run restaurant. They were popular, always bustling with customers, and the revenue was flowing in. But despite this, they were constantly struggling to pay their bills. What was the problem? They didn't manage their cash flow effectively. Their operating expenses were higher than their operating income, meaning they were spending more than they were earning. They had to take on debt to cover these costs, which only led to more expenses due to interest. Eventually, they had to close their doors. Had they kept a closer eye on their cash flow, they might have been able to cut costs and avoid this fate. Now let's look at another case, a tech startup. They were operating at a loss for the first few years, which is not uncommon in their industry. However, they had a positive cash flow. How? They secured investments that covered their operating expenses. This allowed them to continue their operations, develop their product, and eventually become profitable. Their understanding of cash flow helped them weather the stormy early years and set them up for future success. Lastly, consider a freelance graphic designer who was always waiting for late payments from clients. This caused her cash flow to be irregular and unpredictable, making it difficult to cover her expenses. She implemented a new invoicing strategy requiring partial payment up front and the balance upon delivery. This improved her cash flow significantly, allowing her to manage her finances more effectively. These stories show that understanding cash flow isn't just a business skill, it's a survival skill. Whether you're running a restaurant, a tech startup, or a freelance business, knowing how to manage your cash flow can mean the difference between success and failure. So, keep these case studies in mind as you navigate your own cash flow journey. As we reach the end of our journey, let's remember why we started it. We dived into the world of cash flow, aiming to demystify its complexities. We've dissected its definition and underlined the vital importance of positive cash flow for any business. We've navigated the currents of operating, investing, and financing activities, learning to recognize their impact on cash flow. We've rolled up our sleeves to create our own cash flow statements and analyze them to understand the story they tell about our businesses. We've discussed efficient invoicing and receivables and explored cost-cutting strategies without sacrificing quality or growth. We've underscored the importance of an emergency fund, a financial lifeboat in turbulent times. Remember, understanding cash flow is not a one-time event but an ongoing process. It's about making informed decisions, planning for the future, and navigating the ups and downs of business life. With the key of cash flow understanding, you're ready to unlock the treasures of business success. Remember, the journey is as important as the destination.